Using Fibonacci on volume identifying abnormal activity and institutional smart money signatures 1. Core concept. Volume by itself means nothing. Its significance appears only when it is measured relative to the market's normal state. Therefore, we do not ask how much volume there is. We ask how much it deviates from equilibrium. In this context, Fibonacci is used as a deviation scale, not as a predictive tool. 2. Defining the reference points. 2.1 The average volume. Use a volume moving average. Recommended settings. 20 bars for intraday. 30 to 50 bars for higher time frames. This represents the market's equilibrium state. 2.2 Placing the Fibonacci tool. Correct placement is critical. 0.0 Volume floor. 1.0 Average volume line. All levels above 1.0 represent relative deviation from normal activity. Important, levels below 1.0 are irrelevant here. This tool is designed solely to measure abnormal activity. 3. Recommended Fibonacci levels. Keep only the following values. Level meaning 1.50, 150%, initial deviation 1.80, 180%, transition zone 2.00, 200%, institutional activity 2.50, 250%, extreme event 4. Interpretation of each level, key section, small blue diamond 150%, pay attention. Volume is above normal. Common causes. Session opens. Technical triggers. Early algorithmic participation. Not sufficient alone to indicate smart money. Enough to start observing carefully. 180%. Transition zone. This is where conditions begin to change. Activity is no longer random. Often marks. Absorption. Area defense. Power struggle. If price fails to break out decisively at this level, institutional involvement becomes likely. 200%. Institutional fingerprint. This is the critical threshold. Retail traders do not sustain 200% volume. If volume is high, candle range remains small or moderate. Active absorption is occurring. One of the most reliable signs of smart money. 250%. Event, not routine. Stop runs. News releases. Forced liquidity. Warning important. Not every 250% spike represents intelligence. Sometimes it reflects panic, not strategy. The distinction is made solely by price behavior. 5. The golden rule, volume versus price movement. The true institutional signature. High volume with limited price movement. Specifically, volume greater than or equal to 180%. Small candle range. Or internal/overlapping closes. This indicates absorption rather than momentum. 6. Strength through clustering. Do not focus on a single candle. Look for 2 to 4 consecutive candles, each at greater than or equal to 180%. This reflects sustained activity, deliberate positioning, not a one-off reaction. 7. When to ignore high volume. Disregard volume spikes when price expands aggressively in one direction. There is no rejection or slowdown. Momentum is clean and uninterrupted. This is typically momentum continuation or news-driven flow. 8. Logical summary. Fibonacci on volume answers one central question. Has the market left equilibrium? 150% pressure begins. 180% state transition. 200% institutional activity. 250% abnormal event. Direction is always determined by price, never by volume alone.